Welcome to accounting. We're back again today. We're going to talk about adjusting entries. These can be somewhat tricky. So here's how I'd like to introduce it. Sometimes things happen that aren't covered in our normal transactions. We didn't get a bill, we didn't send out an invoice, we didn't record anything in our books, for example. So examples might be time going by, okay? We bought something, we use it up over time, or we finished some work, or we used something up, but we don't have the paperwork to back it up, and we haven't written a journal entry for it. So if we haven't recorded it, we do need to record an adjusting entry at this point. We usually do this at the end of the month or the end of the year. So if money's changed hands, we call these adjustments deferrals. So we're going to defer recognizing the revenue or the expense. Okay? If we completed some work and have not billed the customer, if we've used something up and not recorded it, we consider that an accrual. So we could accrue revenues or expenses as well. Whenever we do an adjustment, we need to calculate the amount and we need to find the correct accounts to use. So let's go through some examples. The first one is a real common one. The company's weekly payroll is $8,700, paid each Friday for a 5-day work week. But guess what? The year ends on a Monday. So employees have worked one day, but the payroll has not been recorded. So we need to write an adjusting entry for that. So what do? That's an accrual. We have to accrue some expense that's not recorded. We have 1 day of expense. We assume there's 5 days in the week. So we take the total amount of weekly payroll divided by 5 days. That comes out to $1,750 a day. So we write an adjusting entry, debit payroll expense, credit accrued payroll, $1,750. Okay? Number two. What's number two? 18 months earlier, the company purchased equipment that costs $20,000. Its useful life is predicted to be 5 years, which time the equipment's worthless. Okay, so we'll deal with some depreciation methods later, but for right now, as 1 year has gone by since we apparently last wrote an adjusting entry for this, we've used up another year of our whatever it was, the equipment. So if the equipment's going to last 5 years, I should say this is a deferred expense, so we paid for it already. Assets get used up. We used up one of 5 years, so we're going to divide the cost by the number of years. So $20,000 cost divided by 5 years equals $4,000 expense per year. So we're going to write an adjusting entry, debit depreciation expense, credit accumulated depreciation, which is kind of a negative asset account, $4,000. Number three. What's number three? Company agreed to work on a new housing development. The company is paid $120,000 in advance, always a good concept in accounting, for the future installation of alarm systems in 24 new homes. The amount was credited to the unearned service revenue account. So through the rest of the year, it looks as though we've completed the work on 20 homes. So we can recognize the revenue on the 20 homes we've completed. Okay, so what do? So we've completed, this is a deferred revenue account. We've already got the money, got the cash, got the check, and we've completed some of the work. We've completed 20 out of 24 systems. So we multiply that times 120,000, so we've actually earned $100,000. 5, 6, looks close to that. Okay. So what we do is we write a journal entry to debit the unearned revenue account. Oops, looks like it's misspelled. For $100,000, we're going to credit revenue for $100,000. That has the effect of reducing our liabilities to complete some work in the future, and it also records some revenue, so we've earned some revenue. Number 4 is the company purchased a 12-month insurance policy for $1,800 on September 1st. So between September 1st and December 31st, we've completed 4 months. So we've been covered for 4 out of 12 months, right? All right. So that's a deferred expense. We've already paid for it. Okay, it's an expense, but we haven't recorded it as an expense yet. It's recorded as an asset. So what we're going to do is say we used up 4 out of 12 months. So we take the cost, $1,800 times 4/12. It gives us $600. So we're going to debit insurance expense $600, credit prepaid insurance $600. Okay. Number 5, our last one, is the company completed a service that's not been billed and not recorded. So all the work that we complete, all of our revenue has to be recognized. So it's not recognized yet. Usually we recognize revenue when we send the owner a bill. Okay? So that is an accrued revenue account. Accrued meaning no money's changed hands. So we're going to record that by simply making believe we did send an invoice out. So we're going to debit accounts receivable, credit revenue, $7,000. Okay? And don't forget, whenever we have an accrual, we probably need to reverse that the following month. And that's the end of our lesson for today.